It is well known that more and more Indians are becoming savvy stock market investors. What with the near ubiquitous SIPs that many of us have? What is perhaps a little less known is the massive change that India's government bond market is undergoing. What is this change that we're talking about? The quick answer is the inclusion of Indian government bonds in one of the largest global bond indices, JP Morgan's Emerging Market Bond Index. Last year in September, JP Morgan made the announcement after 10 years of talks with Indian authorities.
The big headline is that India is going to get added to the JP Morgan Global Bond Index.
The move has significant implication on Indian economy and global investors. It paves way for inflows worth billions of dollars into world's fifth largest economy.
So India was the last big emerging market that has been outside the global bond indices, and JP Morgan is the first one which is adding Indian sovereign bonds to its emerging market indices.
Now, Indian bonds have been included in JP Morgan's Emerging Market Index, but what does that mean for Indian investments and its larger economy?
Since then, life in the bond market has undergone a sea change. India's inclusion in the JP Morgan Index starts from June 28th. From the Economic Times, I am Bhaskar Datta. And in this episode, I will take you through what it means for the country to be included in international bond indices, the euphoria and the risks. It's Thursday, the 13th of June, and you are listening to The Morning Brief. To understand what JP Morgan's decision means for our economy and why it's such a big deal, let's quickly run through what the government bond market actually represents. Similar to how individuals borrow funds to finance their household budgets or their future plans, governments around the world borrow money through bond issuances to spend on developmental activities. Banks and other financial institutions such as insurance companies, mutual funds, and foreign investors buy these bonds and lend money to the government. In the current financial year, the Indian government plans to borrow a little more than rupees 14 lakh crore through bonds on a gross basis. What makes the Indian government's borrowing so important? The government is the most trustworthy entity in the economy when it comes to the ability to repay, given its position as the sovereign. Essentially, this means that there are no fears that it would default on its borrowings, unless the country experiences a calamitous economic collapse. Therefore, the rate at which the government borrows is called the risk-free rate. This is where JP Morgan has now stirred things up. In a global bond index, there are a set of investors, such as large international fund houses, who are mandated to track the index or deploy a certain portion of their money in the countries that are in the index. This means that a long-term flow of foreign capital, estimated at around 20 to 40 billion US dollars, is set to come into Indian government bonds. The word long-term is very important here, because under normal circumstances, foreign portfolio investment in Indian stocks or bonds is volatile and fluctuates according to how the global economy swings. When money of a more permanent nature flows into Indian bonds, it tends to bring down the risk-free rate that we spoke about earlier. Why does this matter? It matters because the risk-free rate of government borrowing is what is used by companies and by other entities when they want to borrow money through bonds. Therefore, when the risk-free rate descends, it becomes cheaper for everybody else to raise capital. The entry of a large, permanent, global set of investors in government bonds also frees up much more room for other players to borrow, as the foreigners start to take up more and more of the sovereign borrowing. This leaves room for banks and for other players to invest in bonds that are issued by other entities. We have with us Mr. G. Mahalingam, former Executive Director of the Reserve Bank of India, and former whole-time member of the Securities and Exchange Board of India, to take us through all the twists and turns that happened before JP Morgan made its announcement. As a regulator who had a special focus on capital markets, Mr. Mahalingam had a ringside view when talks about global bond index inclusion started in 2013 and was privy to why the Indian regulators had for long adopted a circumspect approach. Welcome to our podcast, Mr. Mahalingam.
Thanks a lot, Bhaskar. It's a pleasure for me to participate in the podcast.
So how has India's regulatory framework viewed steps like global bond index inclusion, especially given that it entails a greater degree of international exposure for the domestic market?
That's a very interesting question, Bhaskar. Actually, typically, I'm being pretty candid here. Typically, the Indian regulators have viewed the FPIs as fair weather friends. They are fickle-minded. They don't really come and really help the country in terms of giving a kind of a long-term capital. This has been the view that the regulators have been holding. In fact, I would step back about a decade back when this conversation of index inclusion actually started gaining some traction. At that time, Dr. Raghuram Rajan was the governor of the Reserve Bank of India. When bond index people first came to RBI to discuss this, they were insisting that there should be no limits on the bonds investments by the foreigners, to which RBI was just not actually willing to say yes at all. But then I would say that the regulators have changed a lot. We have been gradually opening the doors to more of FPI investment in the country. Clearly, of course, when it comes to a policy choice, there is always a kind of a policy preference in favor of foreign direct investment compared to foreign portfolio investment. But all of us know that India is a typical current account deficit country. The current account deficit in the recent past has come down. But nevertheless, India needs a good amount of foreign capital to bridge that current account deficit. So realizing this, the Indian regulators have also been a little more practical, and they have been actually looking at India's global bond inclusion in a more positive way. I think RBI has been able to find out a very innovative middle path where they have not dismantled the limits, but at the same time, they have carved out certain securities as fully accessible securities where the foreign investors can invest in an unlimited way. So this shows a kind of a gradual change in the regulatory outlook, a kind of innovative look mixed with a lot of practical wisdom.
So given that you actually were present in so many of these discussions, I cannot help but take this chance to ask you a little bit more about this. I have heard you speaking as well about the concept of the original sin and of opening up the market to too much of FPI investment. So what are the potential risks that can emanate from this kind of international exposure? And more than that, how can regulators ensure least volatility for Indian markets?
Yeah, that's also a pretty interesting question. Clearly, there are risks. I won't say that this comes without any risk at all. As I mentioned some time back, basically when the foreigners come into the country, they are going to be looking at the macros of the country, the financial system stability. They are going to monitor it very, very carefully. So if they get some doubts, if they feel that the country is not doing well on the macros, or there is some problem about the market ecosystem, there could be sudden stops in inflows, or there could be gushing outflows, which we could see in the 2013 taper tantrum episode. When such episodes do take place, which could be a big headache for the regulators, both the exchange rate market and the interest rate market, they come under tremendous amount of volatility. This is where the central bankers will have to put in a lot of efforts to manage this volatility. Of course, one does ask a question. If the central bank is going to be providing this kind of a volatility cushion, what is the real incentive for hedging for the small exporters and the small importers? Yes, it's very, very important because they cannot be really taking a punting view in the markets at all. Over a period of time, I think there has to be a lot of education, there has to be a lot of awareness programs which have to be run to ensure that people do adopt hedging as a way of life, I'm not saying 100% hedging, but then they have to adopt some kind of a mechanism of hedging so that their balance sheets are not open to these kinds of international risks or the risks which are transmitted from the international markets.
I think you've taken us very smoothly into one of the most crucial aspects of this whole business, which is what happens to the exchange rate. So there is a perception that a depreciating bias for the rupee versus the dollar helps to ensure the competitiveness of Indian exports. Now, the RBI says that it steps into the currency market only to prevent volatility in the exchange rate. Does the index inclusion bring a new layer of complexity? I mean, taking forward what you were saying earlier.
Yes, Bhaskar, because there has been a lot of speculation about the amount of flows which are going to come into the market once the index inclusion takes place in June of 2024. Already, I think the country has started experiencing a good amount of flows into the government securities market. The general estimates which are floating around in the market put these figures around 25 to 30 billion. But when such a large amount of capital will be entering the market, clearly it will impact the exchange rate and it will impact the interest rate. But let me actually again add a qualifying statement here. Now, all of us are aware that India is going to get a 10% weight in the global market emerging index of JP Morgan. This 10% is going to be stepped up every month from June up till the next April by 1% every month. So to that extent, if people are going to be tracking the index very closely, now there is again a general perception that whenever an appreciation bias is seen in the currency, RBI steps in. Well, I wouldn't really say that that's a very correct perception. In fact, RBI certainly looks at the volatility. While the volatility has not been defined in a very calibrated way, RBI looks at the way the market is impacted by the gushing flows, and it ensures that the volatility is addressed to some extent. While, again, I agree that a depreciating bias is a more difficult problem for the RBI, an appreciating bias is going to be a little easier problem to tackle. But of course, at the same time, in the case of an appreciating currency, when you are going to buy the dollar and inject a lot of rupee liquidity into the system, it has its own cascading impact on the monetary policy, particularly inflation management and all that. But I think over a period of time, the Reserve Bank of India has developed adequate tools through open market operations, through swap operations and all that to suck out this liquidity, the rupee liquidity, so that its monetary policy conduct is not going to get undermined by such capital flows.
My last question is looking forward. You have seen the government bond market right from its nascent stages to now when index inclusion has happened. Our bond market currently has an outstanding size of around 1.2 trillion US dollars, which is relatively small in comparison to some developed economies like the US. So how do you see the market evolving over the next decade?
Yeah, Bhaskar, if you are talking about the size of the Indian government bond market, you are saying that you are looking at the developed countries and you look at the Indian bond market size as small. Fine. In absolute terms, it is small because the overall outstanding government bonds in India today is roughly about 1.2 to 1.3 trillion US dollar. This is no comparison to the US bond market or even South Korean bond market, where the bond market is of a much larger magnitude. But then let me flip the coin on that side and then look at it. Do we want the size of the bond market to increase, or do we want a vibrant and a deep and a robust government securities market? I would actually opt for the latter. I mean, if you are talking about the size of the bond market, it actually presupposes the fact that the government is going to borrow in a big way, which means the government borrowing programs are going to be supported in a big way by these bond markets. Otherwise, the size of the market cannot increase at all. But if India is going to be clearly getting into the path of fiscal rectitude, as we have been seeing of late, and supported ably by even Reserve Bank of India transferring huge amount of surpluses like 2.11 lakh crores, clearly the fiscal deficit is going to be less of a concern in times to come, provided the government is going to retain the same amount of focus on fiscal management. In that eventuality, I don't see the size of the government bond market increasing in a very heavy way. But then what we need to look at is, while the primary issuances are being smoothly taken out into the market, the primary market is doing well, the secondary market still needs to go at least a long way to ensure there is a vibrant secondary market where the liquidity is available. Today, in a market which has just about 100 to 105 securities, not more than 10 securities are traded very actively. And even out of those 10 securities, maybe the 10-year government security is the most often traded security. The rest of the securities do trade, but then they don't trade too often. They don't have that much of volumes at all. So what we need to look at over a period of time is that how to bring about some kind of a depth in the secondary market by bringing in more investors, by bringing in more issuers, by bringing in more of market makers who can actually be present there with a two-way code. How can we actually ensure that the banks are able to churn their portfolio on a regular basis, which will bring in a huge amount of liquidity into the market. One last point that I would like to make is the Reserve Bank has again taken a wonderful step here of trying to attract more of retail investors into the market. The retail direct program of the Reserve Bank of India is going to be at least doing some change in the mindset to the retailers that they can enter the government securities market. But how many of these retailers are going to be buy to hold investors? How many of them will be churning the portfolio is again a moot question. So my priority here is, rather than the size of the market, I would like to look at the quality of the secondary market, which has to attain greater depth, greater liquidity, greater variety in terms of investors, a greater diversity in terms of issuers.
While a more long-term flow of foreign funds is welcome, you must remember that unlike many countries which have opened up their markets to foreigners, India still has very strict limits for foreign investment in government bonds. Even after index inclusion, the portion of government bonds owned by foreigners would not be as large as some other countries. My next guest, Saket Banka, is the head of institutional sales, markets and security services at HSBC India. Saket, who has handled fixed income products like government bonds for almost 20 years, tells us what happens to the banking system because of JP Morgan's decision. Saket takes us through the market dynamics, as well as how the banking sector in India steps into a phase of global connectivity that has not been seen before.
India's government bond inclusion in the global indices has been discussed for many, many years now. And with GBI confirming Indian bonds inclusion effective June of this year in the index, India has indeed started reflecting more and more in global fixed income conversations. Now, based on various reports, there is about $200 billion of AUM that tracks this index. Effective June this year, Indian bonds will now become part of this index with an allocation of 10%. Hence, if all GBI index tracking investors want to fully replicate the index weightage, $20 billion will need to be deployed into Indian bonds over the next 10 months. Let's look at some numbers to broaden the perspective a little. The current government bond outstanding is at about $1.2 trillion. And this financial year's estimated net new issuances of bonds is at about $130 billion. Current participation of foreign investors into Indian bonds is just about $28 billion, which is 2.2% of the outstanding. Compared to this, domestic mutual funds in India just hold about $50 billion of Indian bonds. Participation from foreigners, like you mentioned earlier, in equity markets is close to about 18%. We look at some other emerging markets. Foreign ownership in local bonds in other markets is significantly higher. For instance, Korea, it's at 21%, Indonesia at 14%, Thailand at 10%, Malaysia at 21%. So if the estimates of foreign participation at $20 billion are actually accurate, this would mean that around 15% of countries' net new issuance in this financial year would be taken up by the foreigners. This would also mean doubling of the foreign ownership into Indian bonds. And lastly, I think the bond index not only opens doors for index tracking funds who actually track the GBI, but also makes way for actively managed funds who would now look at India more closely, either in the hope of Indian bonds getting included in other such indices like Bloomberg Global Ag Index, which is significantly larger AUM, or just participate in the India macro story, given the visibility that bond markets are now getting in the global fixed income markets.
So, as you pointed out, I think the impact of being included in a bond index does not stop at only the government bond market. I mean, we have been hearing that there could be a knock-on impact in many other asset classes. So, is that something that you could give us a little bit more of an idea of? For instance, the rupee or for other segments of the bond market, I mean, apart from the sovereign bond market?
So, while there is a direct impact of index inclusion on the Indian government bond market due to better liquidity, absorption of new issuances, and thereby potentially the bond yields, there is indeed a cascading impact on other asset classes as well. The correlation may or may not be very strong, but let's look at some of them, and let's just start with currency markets, like you said, right? So, currency market, now, if you look at the inflow of money into bonds, the estimated inflow which is likely to come from offshore investors, this would imply selling dollars and has the ability to put some downward pressure on dollar rupee, essentially implying being constructive for INR appreciation. However, in case of outflows, this could change. This could be due to change in index weightage, and this could go the other way around as well, where you have outflows from India and it is INR depreciating. The next, I would say, is banking system liquidity. The supply of dollars into India from overseas investors would potentially put pressure on the domestic INR banking system liquidity. Lastly, like you mentioned, the onshore corporate bond market, which is the debt issued by corporates and not the government of India. If the inflows into government bonds come in and results in bond yields coming lower, this may result in corporate bond yields also to come down to some extent. This would depend on various other factors as well, but if the entire curve of yields move down, this would imply lower cost of borrowings for corporates in the capital markets.
So a knock-on impact of that, basically. I think that's a very interesting point that you were mentioning earlier about the possibility of outflows. Now, we've seen that ever since index inclusion happened, and the RBI has spoken about it multiple times. One thing that stands out is that the governor has very often mentioned that it's a double-edged sword, that it has its pros and its cons. So we have spoken about the pros, but are there any risks that the Indian economy faces from this degree of global interconnectedness?
Indeed, cycles turn. Weightages on the index could be reversed. We've seen that with few emerging markets in the last couple of years. There could be stress on global rates and many such events which would result in flows out from the country. Well, the more dependence on global investors or borrowings the country has, it comes with its own set of challenges. However, in my opinion, even with the inclusion in global indices, the share of offshore investors to Indian government bond outstanding will continue to be small, though relevant. As mentioned, even if we consider full tracking flows come in and some more, we are barely looking at about 5% of the total outstanding, which will be owned by the offshore investors. Also, the build-up of FX reserves to close to about $648 billion by the Reserve Bank provides a substantial war chest in case of significant outflows. So the outflows due to global factors may have a knee-jerk reaction to the domestic markets, but may not have a sustainable impact in the long run.
So I would like to leverage a little bit more on your position as a trader at a foreign bank. Now, we have seen since September, since the announcement was made, that there has been a flurry of activity, particularly in foreign banks. It's well known that foreign banks have very deep and established linkages with global markets. How does this event change things on the ground in India for banks like HSBC? And does it open the door for more opportunities in the banking sector?
Foreign investors were always allowed to invest in Indian bonds, and index inclusion is another enabler. So this is not new to us, and we continue to remain actively engaged with the global investors. Now, your question as to what has changed on the ground. Some of the things which have happened in the background and continue to happen, we are witnessing large number of new investors, new funds getting registered as portfolio investors in India, particularly the index trackers who had never been registered in India because India was not on the index. A lot of educational sessions are happening with the networks team of these investors, their back offices, their mid offices, all through from pre and post trade mechanisms. There is a significant active engagement with portfolio managers just to better understand the India macroeconomic story. We're all gearing up for managing significantly larger volumes, both on the currency and on bonds locally in India. Interestingly, various large investors, portfolio managers, economists, analysts are actually making their way into India to meet industry experts, market participants, and others. And we're doing the same by meeting them in various jurisdictions regularly. In terms of more opportunities, in my opinion, this cascading impact of the index inclusion may not be as material to the overall banking sector, but will most certainly result in significant higher activity across currency and corporate bond markets, thereby creating opportunities sustainably over a longer period of time.
The story of global bond index inclusion has been a checkered one. 10 years back, disagreements about how open India's markets should be stalled the process. In 2022, after the outbreak of the Ukraine war, global financial dynamics underwent a shift as Russia was excluded from many markets. Far more important, however, is the steady growth trajectory that the Indian economy has witnessed and a stable regulatory environment. As the economy grows, perhaps the most crucial cog in the wheel is long-term financing for projects such as infrastructure. A deep bond market with a diverse set of investors and reasonable rates of borrowing are what can drive that aim. 10 years back, India was recovering from the global market collapse unleashed by the US Federal Reserve's taper tantrum. Today, Indian bonds are less volatile than most other markets, even as geopolitical conflicts and uncertainty on US interest rates wreak havoc. At its core, JP Morgan's decision is an invitation for Indian bonds to join the global bond market table. That's it for today. You were listening to this episode on The Morning Brief. It was produced by Neil Gai and Surohini Jain and sound designed by Rajas Naik. Do like, share, and subscribe if you like the episode. The Morning Brief drops every Tuesday to Friday on a listening platform of your choice. Keep listening and enjoy the rest of your week.